This is the second Big Al's Pizza Oven NPV and IRR example video. So before watching this one, please make sure that you have watched video 1. In this video, we're going to look at Big Al's after tax. Now you may recall that Big Al's considering purchasing a pizza oven that has a cost of $60,000, a life of 4 years, net annual cash inflows of $18,000, and a salvage value of $6,000. Because we are looking at this after tax, the discount rate has to be lower due to reduced cash flows. So our after-tax discount rate is 8.5% and Big Al's tax rate is 30%. Now the key concept here is to remember that the only thing that changes is our after-tax payment and our after-tax future value. The input into Excel is exactly the same as before. Now there are 2 ways that we can calculate Big Al's after-tax payment. I'm going to show you both ways, but they always work the same, so you can use whichever one you prefer. The first example is to consider that his annual cash flows are $18,000. But if he has to pay 30% of that in taxes, that means he gets to keep 70%. So after tax, the $18,000 becomes $12,600. Now, because Big Al is a business, he can depreciate the asset. Now, tax depreciation can be complicated, but for our purposes, we assume that Big Al will use straight line depreciation over the life of the asset and that the full cost of the asset will be depreciated. So, $60,000 divided by 4 years is $15,000 a year. Now, depreciation is a deductible expense just like any other expense. We call it the depreciation tax shield. So Big Al has to pay 30% of that cash flow as taxes, but he can save 30% of the depreciation expense. So we multiply that and we see that his depreciation deduction will actually save him $4,500 in taxes. So his after-tax payment is $17,100. Now there's an alternative to compute the same amount. Again, his cash flow is $18,000, his depreciation deduction is $15,000. That makes his taxable income $3,000 from the new pizza oven. If his tax rate is 30%, then his tax expense is $900. Well, if he's got a cash flow of $18,000, but he has to pay $900 in taxes, then he will be left with that same $17,100. So again, whichever way you prefer, you'll always get the same answer. Now, by the time the end of the life occurs, his oven will be fully depreciated. So when he sells it for $6,000, that $6,000 will also be taxable. So again, he pays 30% in taxes, he keeps 70%. So after tax, he will be left with $4,200 from the sale of the oven. So that's how you incorporate taxes into NPV and IRR. Reduce your payment and reduce your future value for the tax implications. Once that's done, we do exactly the same thing we did before. We compute the present value of the future cash flows. His rate is now 8.5%, the after-tax rate. It's still a 4-year life. His payment is $17,100. His future value is $4,200. Now remember to get rid of the negative. We put a little minus sign here. The present value of the future cash flows after tax is $59,043.31. The asset costs $60,000. So after tax, it is not an acceptable investment because our after-tax NPV is negative. We can verify that by computing the IRR using our rate formula. Again, same information, 4 years, $17,100 payment, $4,200 future value. Remember, we have to put the cost of the asset in as a negative. And our after-tax IRR, 7.8%. Again, not acceptable because Big Al's after-tax discount rate was 8.5%. So please let me know if you have any questions. Before I stop this video, I do want to add one additional example to help you with your homework. In your homework, you have a diamond freight problem, and diamond freight works just like Big Al's Pizza Oven with one exception. In the diamond freight example, they are selling an old asset. So let's assume that if Big Al does purchase this new pizza oven, he will sell an old pizza oven for $10,000. Now again, this old pizza oven is fully depreciated, so the $10,000 will be taxable. So he will keep 70%, and after tax, he will receive proceeds of $7,000 from the sale of the old oven. That's the only thing that's different. Selling the old oven does not affect his net annual cash inflow, does not affect his depreciation deduction, does not affect his salvage value. So present value after tax is exactly the same as it was before. What's different is that now he's going to pay $60,000, but he's going to reduce that cost by the $7,000 he receives from the old oven. That's the only thing that changes. So now his NPV is $6,043.31. So if Big Al has an old pizza oven to sell, this becomes a very good investment. Let's compute the IRR under the new set of circumstances. Again, using the rate formula. 4 periods, $17,100 payment, $4,200 future value. But now our cost has been reduced to 53. And the internal rate of return after tax is 13.39%. Again, a great investment with his after-tax discount rate of 8.5. Once again, let me know if you have any questions.